You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Let's roll.
Hey everyone, welcome back to another episode of Market Champions. Today I've got Rory Johnston, the writer of Commodity Context. Rory, thank you so much for being on the podcast. It's wonderful to have you on.
Thanks so much for having me.
Yep. Rory, let's start by talking a bit about your background. So, you don't have the conventional, let's say, finance or economics background. So, you went to Queen's, which is a pretty big university in Ontario, to study the securities and political science and stuff like that. So could you talk a bit about your background and how you made that switch into finance?
Yeah, so I mean, I definitely think my background is kind of heterodox, I think, relative to a lot of my kind of contemporaries. And I think, so I went into university initially with a philosophy degree. So that's why I started as a philosophy major in undergrad. I switched to political science and I kind of went hard towards a security studies stream. I did a lot of my undergrad work on counterterrorism and IR theory, international relations theory, and North Korean peninsula stuff. So that was kind of my focus area. And I came to oil initially through kind of an interest in energy security. So like classic, I read Dan Yergin's The Prize. I'm sure like every other kind of fledgling oil analyst does. And I was like particularly compelled by the energy security elements of it, this idea of, the way it drove World War II and the, Winston Churchill's decision to switch over the Royal Navy from Welsh coal to Iranian oil. I think all those things really fascinated me. So when I went to grad school, I went to U of T's Monk School, great school like yourself. And so my focus there was I planned to continue on security studies. And I was really interested in this idea of energy security. And I think it took me probably the better part of a full year to realize that energy security is a really, really hard job to get directly out of grad school. There are like a handful of jobs in Ottawa, and that's about it. And they're all like, 50-year-old former, either heavy economists or kind of military folks. So my kind of interest area and kind of my way of getting into the industry kind of shifted to whatever I could. And so I by happenstance, I ended up having a conversation, getting introduced to the chief economist at Scotiabank at the time, a guy named Rory Johnston. And I kind of explained why I was interested in oil. And he brought me on board kind of as a junior economist to kind of just talk about, they're like, we need to talk more about energy. So, come on board and kind of learn from us and kind of go as it was. And it was a great kind of super, super lucky break and opportunity in the space that kind of I got thrown into an area that I was kind of had a lot of self-direction and kind of research. I got to publish openly. I kind of got to build a public brand. I got to do a lot of media, a lot of presentations. And after a couple years as a junior economist, the person who had covered commodities at Scotiabank for over 30 years, a woman named Patricia Moore, retired in 2016. And I was kind of offered the position to just take over the entire economics commodities portfolio at, I think I was like 26. So the chief economist at the time basically told me, you'll do fine, but don't worry. I think the phrase was something like, I know you'll be underwater for like 2 years or drinking from the fire hose or something along those lines. And that was absolutely true. I learned kind of very, very fire hose-esque. And after kind of 6-ish years in Scotiabank economics, I decided at the beginning of 2020 to leave for actually a family office. I was going to doing more quantamental equity analysis and kind of helping out with a hedge fund strategy or a kind of equity level strategy. Mm-hmm. And over the course of 2020 and everything that went wrong with COVID and how the markets kind of imploded, we took more and more kind of the strategy, kind of just like seeing what was going on, kind of pulling back a little bit. That was just as commodities went, and particularly oil went completely berserk. So I kept getting a lot of calls from my kind of previous media contacts, and I was like, look, I'm nobody now. I'm not Scotiabank's voice anymore. And they just wanted to talk to someone about the kind of, what's going on and how to kind of understand it. So for me, that was a little bit my sign. It was a lot of media driven, honestly, that there weren't as many kind of voices to fill that space as I was expecting. So for me, I kept doing oil and commodities research to try and kind of not sound like a moron to journalists. And after a while, I was like, why am I not writing this down? And that was essentially how Commodity Context started. I was like, let's start writing this down and see if anyone cares. Will anyone subscribe? Will anyone read it? So I did the free. Yeah, thank you. It ended up going really, really well. And I think it was a focus on my focus is very similar kind of writing as I was doing at Scotiabank, not equity focused per se, not kind of market strategy, just more how I look at this market, how I understand crude oil in particular, as a commodity, as a macro kind of variable. And I did that for basically, it was a free Substack for about a year. And then I've just turned on paid, and I'm kind of building out a broader kind of business around it now. It got enough momentum that it's definitely what I'll be doing for the next couple of years.
No, absolutely. And I think what you're building is very cool. And let's start talking about, everyone's favorite commodity, oil. And
let's do it.
Yeah. And broadly speaking, post-pandemic, we sort of had, especially on FinTwit, we've had this group of very vocal oil bulls, the likes of people like Harris Kupperman and Cuppy's been sort of very vocal in talking about how, the industry as a whole has seen sort of chronic underinvestment. And, we're going to see oil prices hit, say, $400, $500 a barrel in the next few years. So, when it comes to oil markets today, how are you thinking through what's going on, especially in the context of what's going on with Russia and, and obviously the supply constraints and how are you thinking through those dynamics?
Yeah. So I think, what I try and explain to people normally is that, back before COVID, back when I was at Scotia and back when I was kind of doing global forecasting and supply demand stuff, it was, we used to disagree. We used to have, arguments over, 500,000 barrels a day, or that was for the equivalent, about 100 million barrels a day global consumption, give or take, as a ballpark. So we're talking about half a percentage here or there on supply and demand. And that was basically the scope for argument. And it would be, a little higher, a little bit lower. Obviously, 2014 was a break in that. But I think beyond that, that was the kind of main kind of stories, variables we were talking about. Fast forward to COVID, and it feels like every single major variable, every line item in a major supply-demand balance has millions of barrels of kind of error and uncertainty around it right now. We have US supply, which has fundamentally kind of shaped the last decade of our understanding of how much oil costs in the world. Had, prior to COVID, in the decade prior to COVID, the US accounted for more than 2/3 of all incremental global supply growth in the oil market overall. In many years, US supply grew more than global demand did that year, thus kind of forcing a contraction often of kind of OPEC plus supplies. So that was being fueled by a ferocious kind of investor appetite for volumetric growth, but it never really turned around to profitable barrels. So it effectively ended up being a $500 billion subsidy to global consumers, of capital investment that went into the US shale patch that never ended up actually earning a full cycle return. That really fundamentally seems to have broken during COVID. Now, it was something that everyone had always talked about, how this was going to be, this was unsustainable. Eventually it was going to stop, but it took COVID, it seemed, to everyone just turned everything off. And it was that kind of have you tried turning it off and turning it back on again kind of moment. And when the industry rebooted, it rebooted with a much, much lower price sensitivity to investment, or investment sensitivity to price rather. There's a whole variety of reasons for this. And I think, I could talk a full hour just about this, but, very, very, briefly, the main thing people have been talking about for the past year has been this idea of investor imposed capital or investment discipline, that after losing $500 billion, they're like, well, it's our turn to get paid. Please don't ruin this by kind of going gangbusters on growth again. So you're growing less for any incremental barrel, or there's less appetite for growth. At the same time, you have historic oil patch kind of supply chain bottlenecks up and down the supply chain for oil producers, kind of like are being faced throughout the rest of the industrial economy. You have not enough labor, you have not enough steel pipe, you have not enough sand, you have oilfield services companies that haven't invested and kept their capacity going. All this together means that there just isn't as much capacity to grow as quickly at any given price. Normally, you know, they used to talk about the shale band, that below $40 a barrel, shale would turn off and things would come down, and above 60, they would turn on and kind of balance. It was this, you know, economic swing producer argument, but they never really swung on the downside. They only really kind of grew at any given price point. And I think what we're seeing now is that, if anything, you know, at the very, very least, that shale band has been shifted $20, $30 higher. Which in and of itself is a major development. But I think even then, that assumes that, you know, U.S. producers are going to grow at anywhere near the kind of level that they did before. We're going to need 1 million, 1.5 million barrels a day of growth from U.S. shale. You know, right now we're not really on track to get that high. And I think that's this year. What about future years? What if prices fall? You know, et cetera, et cetera, et cetera. They can't hit that level when crude's at 120. You know, it doesn't seem likely they're going to do it at 80. But I think we're still waiting to see. So that's just US. That's just US supply. You know, you've also got, obviously, the COVID waves. You've got China turning its economy on and off kind of on a whim right now, that is throwing massive, you know, I think between March and April, Chinese oil consumption fell by something like 3 million barrels a day, which is just a staggering amount of kind of demand to kind of swing that rapidly. And then you've got Russia, obviously, a historic oil market break, you know, land war in Europe, you know, completely pariah stating the, you know, depending on how you count it, second or third largest oil producer in the world, one of the largest exporters. So all this together, it's just a completely wild market. I would say risks are tilted to the upside, but given the macro backdrop and how everyone else is kind of freaking out at every kind of turn, that isn't to say that oil as a macro asset can't plummet precipitously, as we have seen over the past couple of weeks. But I think that in any environment where we're already struggling to meet supply needs, a company that was considering growth and just had 40% of its equity shaved off probably isn't in an appetite to grow more than a couple of months ago. So I think the kind of pain we're feeling right now is only making our problems worse, it seems.
And I think, you know, the point that you made at the start, where you said that the investment sensitivity to price is going down. So when you say that, so do you mean that, you know, as price goes up, you know, companies are, you know, regardless of what's happening to price, you know, companies are just not willing to invest in additional plants because of the dynamics you stated? You stated later in your answer, where you sort of talked about how, you know, shareholders just do not want, you know, they just do not, you know, they're enjoying record profits right now. They just do not want that to go down. Is that sort of why that's happening?
Yeah, I think it's, you know, the classic individual that kind of personifies this view is a Pioneer CEO, Scott Sheffield. And it's, you know, his kind of quote was something along the lines of, I don't care if oil hits $300 a barrel, I'm not growing more than 5% this year. And I think that is something very, very different than we've seen before.
And so in a way, they're not willing to expand capacity.
Yeah, and I think the challenge is that I mentioned, you know, all those various things, particularly the supply chain bottlenecks happening at the same time. And because they're happening coincidentally, it's difficult to figure out exactly which one is the bigger driver in any given moment. But I think that what we will see over the next year or so is those supply chain bottlenecks begin to ease. And then we're really going to have our test of, okay, now you can grow, will you grow? And I think that will be the bigger question. And I think that's only at that stage, I think, will we really know what kind of, you know, new normal the oil price environment is. Because again, I think there is in my humble opinion, no other single source of supply in the world that can provide the scale of volume that the US can. So it's really, can they or can't they? Beyond the US, and I think when you had asked a question on Twitter about some people, if anyone had questions, and someone was like, where else can grow? You'll get a little bit of growth from Canada. We are still seeing incremental growth in both conventional and oil sands, and now maybe even Eastern Canadian offshore over the next couple of years. So we'll get some growth there, maybe 100,000 barrels a day a year max. You'll also see some growth from Guyana, which is a major new offshore development being led by ExxonMobil. And that is you'll probably see a couple 100,000 barrels a day each year there. A little more from Brazil and its pre-salt offshore. And then basically OPEC, is Saudi and UAE spare capacity. And beyond that, that's it. Like there really isn't many other major areas of growth right now. Like if we had $150 oil for a long time, I'm sure we'd see more develop, but there aren't currently any major prospects that I kind of see in my forecast models that that I'd be looking for upside surprises right now.
And I think the important one seems to be OPEC, and so the sort of the discussion has been that the discussion has been is OPEC or OPEC plus really approaching their limit when it comes to oil production? Now, is that actually going on, or are they doing that just to mess around with the US? What is going on with OPEC? So do they really just have minimal spare capacity?
Yeah, so I think it's important to kind of break OPEC plus into kind of OPEC and non-OPEC. So let's forget non-OPEC for a second, because that's mostly Russia. It's mostly a kind of an other assortment of various kind of troubled producers in many cases right now. But let's look at OG OPEC. There you really only have effective spare capacity, like I was saying, left in two countries. You have Saudi Arabia and you have the UAE. Within the rest of OPEC, you already have chronic quota missing, as people essentially, as producers, can't keep pace with the quotas they've agreed to within OPEC. The two most egregious examples of this are Nigeria and Angola. But you only have a couple million barrels a day, even in theory, left between Saudi and UAE. This whole debate: do they have it? Don't they have it? I think it's really a question of, do they have 1 million barrels, 2 million barrels, or 3 million barrels? It's even on the upside. It's not like they have unlimited spare capacity. Even on the very upside, Saudi has maybe 1.5 million barrels a day more. That's historically low spare capacity, and I think it's also one of these things where we're gonna need it. Again, barring a super deleterious, financial crisis level pullback in global demand that would maybe buy us 6, 9, 12 months of supply catch up. Again, you're going to assume that that's going to have harmful effects on global supply as well, because you're going to see those equities slammed. You're going to see state budgets pulled back, et cetera, et cetera. So all of this, I don't see a situation where we don't at least start to see the extent of those spare capacity limits. And I think it's really one of the first times in history where I think we're going to be testing those limits. And I think it's, a lot of people have ideas. I have, I have various theories, but I've never kind of been inside a Saudi Aramco kind of building, and I haven't seen the well logs. So I think the least I can do, I'm an open source researcher fundamentally. I trust the official data. They have been able to reach higher levels before, albeit temporarily. I think but even if they're telling the truth, I think, like, people are having this big debate, or are they lying or are they not lying? It's really not that much of a difference between them. It's like 1 million barrels a day. That's not a huge amount of it. Going back to that kind of, we already have well more than that on error bands around other major producers like Russia.
Mm-hmm. Yeah. And I believe back in early July, you published, I think it was a free chart deck, on your Substack. And one of the charts that was on it was, the observable total petroleum inventory. And you sort of discussed that, there is no incentive at the moment to really hold, there's no incentive at the moment to hold any inventory. And the reason for that is, is the market is in backwardation. The prices now are higher than the prices in the future. So no one is really incentivized to hold oil into the future. And so how do you expect that to resolve when you look at the fact that total petroleum inventory is sort of near its lowest level on record.
Yeah, and I think it's definitely back at around the low level, below the low level that we saw in kind of 2010 to 2014, which we all kind of associate with this historic kind of tight, high price period. So you're right. So what's interesting is the inventories are really, really low now, right? And that's completely supported in the most rapid drawdown in inventories in history, basically from the latter half of 2020 to the beginning of this year. That was supported by historic levels of backwardation. But what's interesting is that those inventories that I track, which are essentially the global inventories I can see outside of China and Russia. Again, open source researcher. I haven't fine-tuned my satellite tracking models yet, but they're coming. What I can see has kind of traded sideways, interestingly, over the past 4 or 5 months. And I think what's interesting is that coincides with what my supply demand models show as actually a fairly pronounced oversupply in the market, which is the first oversupply in the market since the initial COVID wave. And this was entirely like 95% caused by China's COVID zero lockdowns and that kind of 3 million barrel a day drop in demand. But what's interesting is when you look at their trade patterns for that period, its demand was definitely down, but it was and I've seen other data that kind of proves this out, but Chinese inventories were rising. But what you saw was they didn't stop buying their normal or elevated level of crude imports. So what it effectively was the effective same thing for the global kind of market balances, which is why I think you kind of had this kind of extreme backwardation that persisted through that period of actual global oversupply, which I think was kind of and you did see backwardation ease considerably during that period, but you didn't see it flip into contango, which you would assume it would if you're building inventories at the pace that I kind of, was projecting. So I was kind of scratching my head as to why not. And I think the China explanation, I think, solves a lot of it, which is they were still buying like it was a tight market. And now what we're seeing is now they're coming back, demand is rebounding as the COVID zero lockdowns begin to wind down. And now we're back. So they do have slightly more inventory. So that is, you could consider it a slight bearish overhang on the market, but not a lot. And again, we're only talking a couple months of slower demand in China. And now they're back. The month before COVID zero lockdowns, my numbers had China consuming a record volume of petroleum products. So it's kind of from record highs, to a very dramatic kind of early COVID-esque fall off in kind of demand.
Got it. And so, when it comes to, the demand side, so one thing that we're starting to see is the Fed has become very focused around this demand destruction dynamic. And so what we started to see is sectors like manufacturing have begun to slow down. So now how important is manufacturing when it comes to oil demand? And, is it material? And do you think, the slowdown that we're observing in a lot of these in a lot of these economic indicators as they relate to manufacturing, do you think that is important to consider when you're looking at what's going on in oil markets?
Yeah, I think it's, I think it's important to differentiate kind of, it's not super important to things like consumer fuels to the same degree, but it does correlate quite strongly with the demand for things like diesel fuel, things that are more associated, heavy trucking, all of these things we were seeing about kind of supply chain bottlenecks and, record freight demand, that was very beneficial for diesel demand. Now, at the same time, you have also seen, at least theoretically, some pullback in demand for consumer fuels like gasoline. Now, you could infer a couple things from this. I think some people are saying that it's a sign of early weakness, and I think it's probably right. I think there is some weakness that's being evidenced by those numbers, but it's not that weak. And gasoline cracks, they've fallen back down really quickly. So I think what's going to be interesting is, just the one thing we haven't talked about yet is how on top of this global crude market crisis, we also had an even bigger and more historic crisis on the refining side of the market. So when you and I kind of looked or tried to fill up our car at the gas station, we were seeing $120 a barrel for crude on the screen, but we were paying nearer the equivalent of $180, $190 a barrel for gasoline, because the crack spreads, which is essentially the simple refining margin, the difference between a refined product and the crude that would go into to reform down to make it. That spread jumped from kind of a normal range. Most of my career, it's kind of bounced around $15 a barrel, 15, 20 on a good year, lows of 10, kind of 10 to 20, right? During the heights of kind of this last bottleneck, you saw upwards of $60, $70 a barrel for those crack spreads. So this was the largest kind of refining, dislocation in the market. So I think what thankfully we're starting to see is those crack spreads come back down again. Hopefully that's going to solve some of that problem. And I think that could have gone a long way to explaining why there was some weakness in gasoline prices, because sure, I think we can all debate around what crude level threshold gets kind of demand destruction, but the crude price doesn't matter. The product price matters for demand destruction. And I think we can all agree $120 isn't demand destruction territory, but is $190? Maybe. I think, that gets a little more realistic as to, it was easily costing our family like $150 plus to fill up the car, fill up the family SUV. So that's, that becomes extremely onerous very, very quickly.
Yeah. Yeah. One more thing that I wanted to touch up on was, this idea of the commodity curve, or here specifically for the crude futures curve. And, I wanted to ask you, your most recent writing, you sort of talked about what the crude oil futures curve tells us. And so could you talk a little bit about, one, what is the crude oil futures curve telling you right now? And two, I wanted to ask, what is your general framework for analyzing futures curves?
Yeah, so I think there's a lot of debates, and there's a lot of debates about the latter part of it, the correct ways to interpret. But the first thing I'll start is what is it telling me right now? And then it's telling me right now that markets are slightly less tight than they were a month and a half ago, but they are still at historically tight levels based on the kind of prevailing backwardation in the market. And again, as you kind of correctly explained earlier, backwardation is a state where the futures curve is downward sloping, which is counterintuitive, right? I think this kind of gets to this, my framework for understanding the curve. A lot of people, I think, incorrectly interpret the curve as effectively a market forecast for the price, like the yield curve, right? I think but the difference with something like the yield curve is that there are physical constraints, physical costs and frictions in the necessary storage of crude oil during particularly pronounced bouts of oversupply. And in an oversupplied market, you actually have an upward sloping curve. So when the market is weakest, the forecast seems most cheery, which is that's the wrong part about it. And what it's effectively doing is it's paying for necessary storage through providing arbitrage opportunities for holders of inventory. In a backwardated market like we find ourselves today, it's the inverse. You effectively create an opportunity cost for not selling your crude oil that you have in inventory to the market. And I think a friend of mine, Ted Hall, actually had a really interesting idea that maybe super backwardation, the equivalent of filling super tankers with crude during a super contangoed oversupplied market, is actually borrowing barrels from demand on the other side. Rather than storing them, you kind of pull back temporarily on demand and say, don't do that road trip to this month, do it next month. And theoretically, you could think of the curve kind of serving a similar signal. Again, under the assumption that you could lock in future road trip prices. But basically, I think the front of the curve doesn't say anything about a forecast or an expectation of the market. What it is saying is, and I'll say the front of the curve will be the first 12, 18 months. That'll be your kind of portion that is determined by the kind of overall physical supply-demand balance in the spot market and the necessary inventory economics that are required to clear that kind of lack of balance or kind of unbalance. Imbalance, that's the word I was looking for. So that's what the front of the curve is telling you. The back of the curve, I think, is a little bit more nuanced. And I think there is an argument that the back of the curve, say from the 36, the 3 to 5 year kind of range, maybe that is actually something more like a market expectation of a marginal kind of supply curve kind of, incentive price. And what you saw there, and when you look at the kind of back of the curve over the last 20 years, you see a really, really interesting kind of shape. And you see this absolutely mega spike during the 2008 financial crisis. And this was like peak supply, if you will. This is when everyone was legitimately worried we were running out of fuel, like oil tomorrow. I remember I watched like a documentary back. I was in high school at this stage. I remember watching a documentary, and it like petrified me that we were running out of oil tomorrow and society was going to grind to a halt. This is like the era of, Jeff Rubin and kind of, the world is going to shrink. And that kind of, that came and went. Then you had this higher price period where the back of the curve was up around 90 to $100 for most of that kind of 2010 to 2014 period. And then when the shale oversupply came, that back of the curve, that expectation dropped to $60 or lower. I think that tells you that there was this change in view that this was the new normal, that, we were never kind of unanchoring from here. And any producers or consumers that wanted to hedge far out, that was where they were landing on some kind of presumed fair price. Now, what we've seen in the latest kind of since COVID and since this latest price spike is we've seen the first real kind of durable breakaway from that 2014 to 2020 period. But we notably have $15 to $20 or more to go before we reach that pre-2014 level, even though spot prices were much, much higher than they were in 2014. So I think that's this, I think the futures curve is saying the market is historically tight today, but the market doesn't necessarily buy that it's changed. It shifted expectations, but it hasn't fundamentally changed them. I think, the long-term expectation for oil prices is still lower today than it was pre-2014. But I think it's just going to take a couple more years, or maybe even, maybe a year or less, who knows, whether or not, for higher spot prices to finally pull that back of the curve up. I think maybe if you see, whether this is, shale still doesn't grow when the supply chain bottlenecks unwind, or we run up against some kind of unexpected early limit to OPEC production capacity that we don't currently see, or whatever the trigger is going to be. I think it's going to need something like that to reprice the back of the curve again. Because I think that is, for a lot of oil producers, still what they're looking at in terms of their guidance. And at the beginning, I said, the curve is not a forecast. It's not the market forecast. Mm-hmm. But I still think a lot of people look at it as that. So I think it still has that kind of behavioral investment kind of, transmission channel, if you will.
Mm-hmm. And so in a way, the curve is not a forecast. It's sort of, but basically what it's telling you is that though the market is tight today, it may not be, this tight in the future.
Yeah, exactly. And I think there's a fair part to that, right? Which is like oil is a very cyclical commodity. So if it's really, really tight today, it's probably a reasonable bet that it's not going to be super, super tight in 2 years. Whether or not past is kind of prologue here, I think that's yet to be determined. But that hasn't been a terrible bet over the last 20 years, that bouts of exceptional tightness are usually followed by less tightness. But again, in that past, we had a ferociously growth kind of obsessed shale patch. And that's, I think, what is very fundamentally different today.
Mm-hmm. Yeah. Okay, so if we go, let's shift and talk. So we spent a lot of a lot of our conversation really talking about supply. So if you go to the demand side, what is the demand side looking like? And I think you touched upon what China's doing with regards to its lockdowns and its mass quarantine. So they sort of they've been flipping the economy on and off at their whim. So how do you think this plays out from the demand side? So broadly the supply story has been that it is hard to that in a way the supply and the inventory those type of stuff, that type of thing is very tight in this market. But what does the demand look like?
Yeah, and I think so. Overall, globally, just before those COVID zero lockdowns, we had just kind of more or less reached pre-COVID levels overall. Now, I think the important thing to remember there is just because we reached pre-COVID levels does not mean that we reached pre-COVID trend, right? We still had plenty of upside to go if you were to see a real kind of renormalization back to trend, as one could expect, or like you've seen in other kind of, consumer spending metrics, for instance. That we haven't seen yet. And most of that is because we still haven't seen a real rebound in global international air travel. That's still the major factor that's kind of holding back. I don't have the number in front of me, but somewhere in the ballpark of it's still down like 50% relative to where we were pre-COVID overall. That I think is, that's that kind of structural element. Then you also have this policy risk element that's two-pronged. One, you have a policy risk element in China, as you were saying, them kind of willy-nilly kind of turning off and turning on the economy, which is very disruptive. Obviously, not only is it disruptive to oil demand now, but it also hampers and kind of harms the global macro environment, which increases the probability that we fall into some kind of particular, especially deleterious recession. So I think there's that front on China, and how are they going? Where is it going? I have no idea, because I think if you had rewound a couple months ago, I would have said, oh, would they have shut down 40% of their economy 2 years into COVID because of a couple hundred cases? That seems unreasonable. I don't think they're going to do that, but they did it. And whether or not they keep doing it in the future, I think that there are other people that have much better views on that than I am. I think eventually, it normalizes. Eventually we get out of this. Eventually, China will set kind of new all-time high demand numbers again. And I think, unless something seriously changes over the next couple of months, that's probably going to be later this year, early next. But again, I think it's obviously been so volatile. On the ex-China side, there's this kind of other kind of question of this broader macro malaise that we're obviously stuck in. And it's very much, as you were saying, I think at the outset, it's very much a policy choice of central banks throttling back global economy, the overall global economy, to kind of reduce some of the demand pressures on inflation. And I think, as we were saying in a different context earlier, but I think the challenge is given the extent to which, obviously there is some demand element here. I don't think anyone's arguing otherwise, but there's very much seriously a supply element also going on. And, Chairman Powell himself, I think, has said, he can't affect the supply side, but he does have a commitment to price stability. Now, what that means is, really throttling back demand as much as he can. But as we were saying, again, in another context, that also has financial market implications, which have reduced, I think, the incentive or the kind of, allowance for U.S. shale to grow again. I think if you're looking at it through this lens of supply discipline, and particularly investor-imposed supply discipline, the nearest metric I could think, you can think of as a barometer of how close we are on a relative basis to kind of finally getting, investor approval to grow again. Well, it's equity prices. And I think if your equity price was at kind of a multi-year high back in early June, maybe you were actually thinking, maybe we'll grow. Maybe next year's plan is gonna, to actually grow and kind of lean into this mega cycle and try and gain some market share because no one else is growing. But then, I made this joke on Twitter that the C-suite's having this debate, and then the intern scrambles in and says, just to let you know, the share price is down 40% and oil is down $30. And then they, throw the growth guy out the window, because I think that, that just doesn't seem like a very popular kind of, set of circumstances in which to grow.
Mm-hmm. Yeah. And so, how would you, for example, if you were, say, the U.S. government, so, how would you actually work on resolving these, these higher prices? So far, we sort of discussed that, on the demand side, there's only so much you can do. And then on the supply side, then again, Jay Powell has very little power on the supply side. And, what really happens? So, what can, say, the U.S. government actually do in the situation? Do they have to go ahead and, say, massively subsidize the construction of new refineries, or do they have to subsidize the production of oil? What really has to be done in this situation?
Yeah, I think it's a great question. I think on the refining side, we're probably going to be okay. I think it's, as I wrote another piece on commodity context, I very much view the majority of the issue on the refining side as this collapsed bridge between, the legacy refining fleet, much of which is situated in the West, and the new age of these new highly sophisticated refineries coming online in places like Nigeria, places like through the Persian Gulf and into India and China. And this was always going to be a major source of competition for these legacy refiners that was going to be hard to compete with. What we saw during COVID was a bunch of those legacy refineries closed early because of COVID, and a bunch of the refineries that were supposed to be coming online opened late or had their open dates pushed back. That opened up this kind of gulf in the middle that was and I know transitory is, a dirty word in macro these days, but it is like fundamentally a transitory kind of a bottleneck that should, that should kind of solve itself. A big part of the reason why you didn't see more investment in Western refineries was because you saw this competition coming down the line. You can't hide these facilities. Everyone knew they were coming, right? They're massive. So that's still coming down the line. I think that will help ameliorate the refinery side. On the, upstream side, let's say crude oil, I think it's a much trickier issue because at the one end, you have, a very real need to decarbonize the economy. But at the same time, the period between now and net zero, we're going to need a lot of oil. But who is going to put that capital at risk for projects either that kind of, are opposed locally now or kind of might not see demand to break even later? That's a huge risk for companies. It's a huge risk for investors. So I think they're reasonably apprehensive about kind of deploying that capital. So the question is, how do governments help send that signal without kind of, outright nationalizations? I think, which, I heard another podcast recently, people like, are nationalizations an option? Well, it's like, well, probably not. seems like a bad idea. But I think there's also this very reasonable question of like, maybe if, are there elements that could be bolstered in terms of state capacity? And I think my friend and I, Skanda, have done a lot of talking. We were on the Odd Lots podcast talking about the Strategic Petroleum Reserve and how that could be used in different contexts to help even out some of the volatility in oil markets. I think that is an interesting way of kind of thinking about a new frame of state capacity in this era of volatile energy transition. I think you're also looking at, obviously, in Europe and this massive issue of reliability of Russian gas. Is there space that even if the governments don't want to open free range for private companies to explore and produce gas in Europe, maybe a state actor could effectively build a strategic gas reserve in the ground, right? It's already there. You just have to build a capacity to produce it when needed. So I think there are a bunch of options, but I think the challenge is that the market is going to be very, very challenged to deal with this in an efficient way because of all those uncertainties bouncing around and because of those mismatches of kind of, near-term and longer-term incentives that make it very, very difficult to get the market to solve, if you will, at least not in an extremely volatile way. And I think this is a very rough early example of what that energy transition, I think, can look like if not handled well.
Yeah, and that brings me to my next question. So I did want to touch up on the SPR, the Strategic Petroleum Reserve, and so I believe the first time that Biden actually released some oil from the SPR or announced the release of oil from the SPR, if I remember correctly, oil actually went up. And, the consensus, at least on FinTrade, was that this was sort of a sign of desperation in the sense that, it's gotten so bad that Biden actually has to use the SPR in order to, bring oil prices back down. So how are you thinking about the SPR? And, you sort of mentioned that you had some ideas around how the SPR could actually be used more effectively just within the scenario that we're facing right now. So how are you thinking about the SPR and what can be done with it?
Yeah, so I think there's a couple of ways to think about the SPR. I think there's a right way and a wrong way to use the SPR. And I think when you look at the Biden administration's decision to its first SPR release back, I think it was in December of 2021, maybe it was November. But that I think was a bad SPR release. It was a simple, straight emergency release. this is the one that I think you were saying, the price went up, you was seen as a sign of weakness. I think if anything, I probably disagree with the extent that it caused, I think it was a coincident factor. All else equal, and particularly because those barrels weren't being released in the market yet when it was announced, right? So when the barrels are released, they are real barrels. If all else equal, that should bring prices down. But I think the challenge is that if you bring prices down with finite temporary supply, which is what I effectively think of the SPR as, kind of discretionary supply, that I think makes your situation worse, right? It's just borrowing from the future, and you have to pay it back.
Yeah.
Now, I think what you've seen since then, and basically earlier this year, the Biden administration announced a all-time largest SPR release in history, coordinated with multiple countries around the world. Overall, it was something in the order of 1.5 million barrels a day of capacity. That is a massive amount of incremental oil to the market. I think that has fundamentally helped stabilize the market today. The challenge is again, are we just simply borrowing from the future? And so far, we are. But there have been early good signs that particularly the U.S. administration is thinking about it in a different way now. And I think I've written a bunch of pieces about this. The good analysts over at Employ America have done really, really good work on the policy and legal side of this. The idea essentially is to use the SPR in a way as a kind of inventory battery. And this is, again, more my slant. The Employ America has a better or a kind of a more broader kind of financial, options contract infrastructure. Mine is just straight simple. I'm a simple guy, basically treated as a massive discretionary source of inventory, a battery for the market. In periods where the market is exceptionally backwardated, like we find ourselves today, you would sell heavily into that market. And then immediately what you would do is you would buy the same barrel back some distance down the curve, whether or not that's a year, 2 years, 3 years. I think there you have scope for deciding how you're going to do it. But the idea is not just to push down the front of the curve, but to pull up the back of the curve, which again, through this kind of idea is what this should signal to the producers is that there is more demand back there. It makes a whole variety of their hedging more attractive. It can lock in guaranteed supply if they are concerned, guaranteed demand if they are concerned about that. That is, I think, what something like the SPR should be used to do now, because it's kind of traditional conception, I think, it's historically been underutilized and has been instead kind of used as a random piggy bank occasionally by Congress to pay for discretionary items. But again, it's a hugely unique asset in the global oil market in that it is, it's inventory that doesn't need to follow, backwardation or contango signals. But I think it can do it especially well if kind of directed to by the president. And I think that is, a better way to use it to try and just smooth out some of that like intertemporal volatility and try and stabilize the market in a very direct way. That I don't think any other aspect of the economy can do as well. It's almost like the inverse of kind of Saudi production. They can go up or down, and U.S. has a capacity to produce over 1 million barrels a day on, if it wants to, but only for a temporary period of time. And I think you get run into a bad situation if you just sell it all down and then you just don't do anything. And I think that's the worry that I have right now. And again, we have seen signs from the Biden administration that they are thinking about this in a different way. There's been a whole suite of proposed rulemaking changes that allow them to do different things with forward contracts. I think that you have seen really interesting progress there. And I think, one of the opportune things about this energy crisis is it gives us a very, very early kind of moment to think about how to structure policies around what I, again, think will be a very, very volatile transition. And I think it's the responsibility of governments today to think about how to manage the next 10, 20 years of energy price volatility so that we kind of get to a net zero future without, periodic bouts of economic crisis.
Yeah. And with that in mind, and your last point about how governments need to manage it, let's go across the Atlantic to Europe. And so, Europe is in many ways facing a different crisis compared to the US. It's simply because they import a huge amount of their energy from Russia. And, as we know, Russia is engaged in a conflict with Ukraine. And what we're broadly seeing there is we're seeing these incredibly high natural gas prices, to an extent, higher oil prices, etc. We've seen their electricity prices, for example, go through the roof. And how do you, what would you, if you were responsible for solving the crisis, or in Europe, or you were supposed, or you had to sort of figure out how this would all resolve, what would you be doing, how would you actually resolve the crisis in Europe, and how do you actually think it's going to be resolved? Do you think we're going to see a shift towards nuclear, for example? Do you think we're going to eventually see Russia get sort of sentenced as the international pariah, and everyone starts to shift away from Russian oil? How do you think this plays out?
Yeah, and I think I'll split the answer in two here. And on the first part, on the let's say the gas and power side, I will fully acknowledge broad opinions and awareness, but my main kind of expertise and kind of research focus right now is on the oil side. Mm-hmm. On the gas, and that's I think what we'll talk about just quickly second. On the power and gas side, I think there are definitely, obviously, this is an existential crisis for Europe. I think many people have known for a long time that Russia probably is not the most reliable supplier of gas and kind of critical energy. But despite this, there hasn't been no one took it seriously until now. Thankfully, people are starting to take it seriously now. Whether or not they will be able to, address the issues quick enough, I think is a major kind of question. Obviously, there's some kind of attempts at getting more and more liquefied natural gas export or imports, particularly from the U.S. I think Prime Minister Trudeau has talked about kind of more LNG liquefaction capacity on the east coast of Canada, which is a great idea. It won't be ready for this crisis, unfortunately, but I think it's a good idea regardless, and it will be helpful in the next crisis. But has Germany seemed to have backpedaled on its nuclear retirements? No. They're bringing back coal instead, which is bad because coal isn't great, but I think it is necessary in this moment, again, to avoid an existential kind of crisis. So I think it's a whole bunch of kind of it's just a really, really bad situation, and I think that if anything, it is worst for Western Europe today. I think this is much worse for Russia in the long term, though. Again, this is the idea of the energy weapon, kind of to a T, that Putin is using gas exports to squeeze Europe. This is not something that you can do repeatedly. This is something that this is it. Europe has got the message. Russia is no longer a reliable supplier. They're moving dramatically quickly to find, other liquefied natural gas import opportunities, or kind of, they have changed their rules and kind of policies around nuclear in the rest of the EU. You've seen kind of a major prioritization of building out kind of an industrial policy around things like heat pumps, which kind of allow, it's basically electrified alternative to natural gas fired kind of furnaces. So I think that's all good for Europe in the long term. It's just, again, this is it's a worst case scenario for the volatility and human suffering and economic suffering of all of this happening kind of at once. But again, at the end of this, Russia is effectively going to have permanently reduced the demand from its previously largest purchaser of gas and oil. Then with that, we'll switch to the oil side. The oil side, I think, has been confounding to date. I think the way the various policies and sanctions have trickled through has been counterintuitive, to say the least. What we've seen initially when the sanctions hit was broad self-sanctioning, because when the sanctions first came on, they explicitly excluded oil and gas. That very quickly kind of it gave way. But even before it gave way to actual explicit kind of prohibitions on imports, let's say from the U.S. or Canada. It was the self-sanctioning activity of companies that were trying to avoid public reputational harm. I think the greatest example is Shell bought a shipment of Russian oil at the beginning of the crisis, kind of in line with what it was, with what all the rules said it should be able to, and then was basically forced a couple of days later to kind of backpedal and say that they're not going to buy Russian crude anymore. So this effectively actually hit refined products first, and this also helped add further fuel to the fire of the global refinery crisis. You lost about 1 million barrels a day of Russian refining capacity. in that first month or two of the self-sanctioning activity, as people kind of pulled back from a lot of this kind of what we call intermediate product, things like vacuum gas oil or fuel oil, things that are kind of semi-refined but need to be sent to another refinery to kind of refine further into diesel and gasoline. That was what got cut back, which reduced the effective refinery yields of a lot of the traditional refiners that consumed that product. Much of which was consumed in Western Europe and the United States. So that helped precipitate that. But all in all, what you ended up seeing was this massive pullback. That trickled through to demand for domestic Russian crude, and that backed up into their inventories. And then their production fell by over 1 million barrels a day. And we thought that was kind of the start of something, calamitous, right? That was the beginning of the end. And then that was the bottom. And then it started bouncing back. And you saw much more capacity than I think people were initially expecting, myself included, for Chinese and Indian buying, particularly Indian buying of Russian crude exports, particularly from the Mediterranean and kind of the Baltics. So I think this was this challenge that, now it's increasingly going to Asia. It's going there for a steeper discount to justify the extended kind of logistics and the kind of limited buyers. But it's still going there. Now, how much further can it go? I think this is what everyone's debating. No one knows exactly how the proposed insurance ban is going to ricochet through. It's going to mean that Russia can't use upwards of 90% of the global shipping fleet. But can they make do with what's left? Can they build another pipeline to Asia? Can they put more on rail cars? Can they do these ghost ship kind of transfers where it kind of sneakily gets into the global supply chain? I think there's a lot of scope, and I think at the end of the day, until Russia has proved more resilient, I think it's still early days. I think in the longer term, the question is, can they maintain production if they've lost Western joint ventures with Western oil majors, and they've lost the expertise and kind of technical capacity of the oil field service companies. I think all of these things that have pulled out of the country are as kind of an anchor around the weight, around the neck of Russian production. And I think at this stage they're proving resilient, but I still expect that the trend is going to be the downside, even if this is a kind of a temporary boost back up.
Yep. Rory, thank you so much for being on the podcast. Before I let you go, could you tell the audience a bit more about where they can find you on Twitter, etc., as well as your Substack?
Yeah, thanks so much again for having me. On Substack, it's a Commodity Context. It's commoditycontext.com. And that is a kind of premium, chart-forward, kind of data-intensive look at the commodity market. And I kind of publish usually about once a week, some kind of content, and that's going to continue building over the future. And I'd love for you to join me. And on Twitter, I'm at Rory_Johnston, and I kind of live tweet a lot of my research process there. So if you don't join the Substack, follow me on Twitter, and you'll get a lot of different content.
Yeah, Rory, thank you so much for being on. It was awesome talking to you.
Thanks so much for having me.